ready to dive into a world of property, income, and taxes. We're going deep into HMRC's Property Income Manual today.
Yeah, it's more interesting than it sounds, trust me. We'll be uncovering some hidden opportunities, maybe some tricky things you need to watch out for, whether you're a seasoned landlord or just starting out.
All right, let's kick things off by identifying the players in this property income game. We've got your individual landlords, pretty straightforward.
Right, but then it gets interesting, right? You've got your non-UK resident companies, trustees, partnerships.
It's a whole mix.
It is a whole mix, and it's super important to understand because HMRC doesn't treat everyone the same.
That's right. Different rules for different folks. So how does HMRC distinguish these different players in the property income game? Why does it matter?
Well, the type of landlord you are really impacts how your income is taxed, right? So, for instance, an individual landlord, they usually pay income tax on whatever profit they make from their rental income. But if you're looking at a non-UK resident company, completely different story. Since April 2020, they were switched over to corporation tax.
Oh, wow. Okay, so that's a significant difference. So knowing where you stand with HMRC is essential from the get-go. But let's move on to the income itself. It's not always as simple as just rent payments, is it?
Not at all. You'd think it'd be straightforward, but the HMRC manual gets a bit creative with what they consider property income.
Okay, I'm intrigued. What kind of creative interpretations are we talking about here? Give me an example.
So imagine you own a piece of land and a cable company pays you to run their cables across it. That's a way leave, and guess what? That's classed as property income.
Interesting. So even if you're not directly renting out a property, you could still be liable for property income tax.
Exactly. Or let's say you rent out your property for a film shoot. Those location fees, HMRC sees that as property income too.
That's fascinating. So that unexpected film crew could mean more than just a good story. It's a good reminder to stay informed about these less common income sources.
Absolutely. And, while we're on the topic of unexpected things, let's talk about joint ownership.
Okay, joint ownership. Seems pretty straightforward on the surface, right? You split the profits, you split the losses, everyone's happy.
Well, not so fast. HMRC can sometimes see it differently, especially if you're offering certain extras to your tenants.
Okay, now you've got my attention. What's HMRC's issue with providing a bit of extra service? What's the big deal?
It's all about the line between joint ownership and, let's say, running a business. Let's imagine you and a friend. You buy a property together, and you decide to jazz it up a bit. You offer laundry facilities, maybe even a 24/7 reception, just to give your tenants the best experience.
Sounds pretty swanky. So what's HMRC's take on this? What's the problem?
The problem is HMRC might see those extra services and think, hang on a minute, this isn't just passive income from rent anymore. They might view it as you and your friend operating a business together, a partnership.
And why does that distinction matter so much? What changes if HMRC decides your joint ownership setup is more like a business partnership?
It's all about how the income is treated. A partnership, in the eyes of HMRC, is its own separate entity for tax purposes. This means any profits or losses from that property, they're not just part of your individual income anymore. Nope, they get assessed and taxed separately under, you guessed it, partnership rules.
So if you go into joint ownership thinking you're just splitting some rental income, but HMRC sees it differently, that could lead to some unexpected tax implications. It's a bit of a curveball.
Exactly. And believe me, we're only just scratching the surface here. There's so much more to uncover when it comes to property income tax in the UK.
Okay, so we've explored the different players in the UK property income game. Now let's get down to the numbers, specifically the accounting methods you can use. Our trusty HMRC manual delves into the differences between the cash basis and GAAP, generally accepted accounting practice.
Right, and honestly, understanding these different accounting methods is crucial. It can actually make a big difference in how much tax you end up paying.
Okay, I'm all ears then. Break it down for me, cash basis versus GAAP. What are the key differences, and why should a landlord care?
So think of the cash basis as the more straightforward option. You recognize your income when that rent money hits your account, and you deduct your expenses when you pay them. Simple as that. It's been the default for a lot of landlords since the 2017-18 tax year because it's usually easier to manage.
That does sound pretty appealing, especially for someone like me if I were just starting out as a landlord. So just to be clear, if a tenant's a bit slow with the rent, I don't account for it until it's actually in my bank account, right?
You've got it. However, and this is a big however, there are exceptions. Capital expenditure, like if you're doing a major renovation, and car-related expenses, those follow specific rules. Even with the cash basis, you can't just lump a brand new kitchen remodel into your day-to-day expenses.
Right, makes sense. So even though the cash basis might seem simple on the surface, there are definitely areas where detailed record keeping is still crucial.
Got it. Okay, now tell me more about GAAP. When is that the more appropriate method to use?
GAAP, that's the more comprehensive approach. It's often required for companies or for landlords with more complex setups. The main difference is you recognize income and expenses when they're earned or incurred, regardless of when the actual cash changes hands.
Okay, I think I get the concept, but can you give me a real-world example of how that would work in practice? Sure. Imagine you have a tenant who's super organized and pays a whole year's rent up front. Under GAAP, you've got this lump sum, right? But you would spread that income out over the 12 months that it relates to. So it's about showing a more accurate picture of your earnings at any given time.
That makes sense. So it's not just about what your bank statement says at any given moment. It's about reflecting when the income was actually earned or when the expense was actually incurred. Okay, that makes sense. Now, let's say I'm currently using the cash basis, but I'm thinking about switching over to GAAP. What does that transition look like?
It's definitely not as simple as just ticking a different box on your tax return, unfortunately. Switching accounting methods requires some careful planning, and you'll likely need to make some transitional adjustments.
Transitional adjustments. Okay, now you've really lost me. Explain it to me like I'm 5. What are these adjustments and why are they necessary?
Basically, these adjustments ensure you're not accidentally deducting the same expense twice or misrepresenting your income during the switch. It's about making sure everything lines up perfectly between the two methods.
Okay, so it's all about maintaining accuracy during the switch. Can you give me an example of when I might need to make one of these transitional adjustments?
Absolutely. Let's say you're super organized and decide to prepay a whole year's worth of insurance for your rental property while you're on the cash basis. You deduct that entire amount in that tax year, right? But if you switch to GAAP, you'd need to adjust for the portion of that insurance that actually covers the following year because you haven't actually incurred that expense yet under GAAP.
Ah, I see. So it's about making sure those deductions from your previous method are accounted for correctly, but not double counted. Under the new method, it sounds like there's a bit of a balancing act involved.
Exactly. And that's why this HMRC manual is so valuable. It lays out all these little details and helps you navigate these transitions smoothly. It's all there in black and white.
Okay, that's good to know. It seems like doing your research and understanding the nuances of each method is absolutely crucial.
You got it. And, taking the time to understand these details, even if they seem a little tedious, it can save you a lot of headaches and potentially even money down the road. But accounting methods, those are just one piece of the property income tax puzzle.
All right, we've talked about who's who in the property income world and how to keep our books in tip-top shape. But now let's talk about keeping more of that hard-earned rental income. Let's dive into deductions.
Yes. Deductions, always a good topic. And this is where the HMRC manual gets really specific, especially when it comes to repairs versus capital improvements.
The eternal struggle of fixing what's broken versus making things sparkle. So for all the landlords out there, what's the key difference in HMRC's eyes and why does it matter so much?
It all comes down to whether you're simply maintaining your property or actually enhancing it. Think of repairs as keeping things in good working order, just like a bit of TLC. So let's say you need to replace a few cracked tiles on the roof. That's a deductible repair. You're just preventing further damage.
Makes sense. But what if I wanted to upgrade to a fancy new roof altogether? Where's the line between a simple repair and a capital improvement?
That's where things get interesting. If you're replacing something like for like, even with slightly better materials, it's usually still a repair. But if you're making a substantial change, something that adds value to the property, like a complete roof upgrade, that's when those capital expenditure alarm bells should be ringing. HMRC might see that as an improvement, not just a repair.
So it's all about the scale and nature of the work being done. A simple fix, a repair, a major upgrade, capital expenditure. Okay, got it. Now let's move on to another biggie, financing costs. What do landlords need to know about deducting those expenses?
Finance costs. This is a big one, and it's an area where recent changes have made things really important for landlords, especially those with residential properties.
Okay, I'm listening. What are these changes, and why should landlords be paying attention?
Well, since the 2017-18 tax year, there have been some pretty significant restrictions on how much mortgage interest and other finance costs you can actually deduct from your rental income.
Hold on. So if I have a buy-to-let mortgage, I can't fully deduct the interest I'm paying on that loan? That seems like a big deal. What's the reasoning behind that change, and what does it mean for landlords in practice?
You're right, it has been a big change for many landlords. The deduction is now capped and is being phased in gradually. The idea was to create a more level playing field in the housing market, but for landlords, it means they can't offset as much of that interest against their rental income, which could lead to a bigger tax bill.
So it's definitely something landlords need to be aware of and factor into their calculations. Now, beyond those big ticket deductions, are there any other noteworthy reliefs or allowances hidden within this HMRC manual that we should know about?
Absolutely. There are some real hidden gems in there. For example, there's the replacement of domestic items relief. This allows landlords to deduct the cost of replacing things like furniture or appliances in their rental properties.
That sounds incredibly practical and helpful. What about those more unique landlord situations? Say, for example, I'm renting out a spare room in my own home.
That's where the rent-a-room scheme comes in. It's designed to make things simpler for landlords who are renting out a room in their main residence. You can actually earn up to a certain amount completely tax-free.
That's amazing. So it's a great option for someone testing the waters of being a landlord or just looking to earn a bit of extra income from a spare room. Are there any catches, any conditions you need to meet to qualify?
Of course, there are always a few details, right? The main thing is the letting has to be in your principal private residence, and you can't claim any expenses against that rental income. So there are definitely pros and cons to weigh up.
Sounds like doing your research is key, as always. Now, what about those furnished holiday lettings I keep hearing about? I've heard whispers that they come with their own set of tax advantages. Is that true?
It is. Choosing the Furnished Holiday Lettings classification, or FHL for short, can come with some sweet tax benefits. But, and you probably saw this coming, it's not as simple as just calling your property a holiday let. HMRC has some strict criteria you need to meet, like how often you let the property, how long it's available for, things like that.
Right, so there's potential for tax breaks, but only if you meet all the requirements. Okay, last but not least, what about those landlords who live abroad? Surely they can't escape the watchful eye of HMRC when it comes to UK property income, right?
Not a chance. The HMRC manual has a whole section dedicated to non-resident landlords. They've got their own set of rules to follow under the non-resident landlord scheme, which outlines their tax obligations.
So no escaping the tax man, even from across the globe. Well, we've covered a lot of ground today, haven't we? We've deciphered accounting methods, tackled the difference between those all-important repairs and capital expenditures, and even unearthed some hidden gems for landlords like the replacement of domestic items relief and the rent-a-room scheme.
It's been quite a deep dive. Remember, this HMRC manual, it's a living document, constantly evolving. New legislation, new interpretations, it's all in there. So staying up to date is key.
Absolutely. Well, I'd say our listeners are now well equipped to navigate the intricate world of UK property income tax, maybe even make some savvy decisions that could save them some money.
Exactly. Knowledge is power, especially when it comes to taxes. Don't be afraid to dig deeper into that HMRC manual. Explore the sections that apply to you.
And on that note, we'll wrap up this deep dive into the fascinating world of UK property income tax. Until next time, happy letting.